Welcome to Thursday, August 27th. It's hard to believe that it's already Thursday. Thank heaven tomorrow's Friday, but I'm more thankful than that we have Ken DeGraw here to explain bankruptcy opportunities for CPAs. Ken is one of, if not the most qualified forensic bankruptcy experts, having an entire department of his CPA firm dedicated to this. Besides that, Ken is a very, very practical guy. I learned a lot last week, and I'm going to learn a lot this week. You can watch last week's talk by just going to this YouTube address, and there he is. He's not Michael Jackson, but he's still entertaining. But we promised our friends at Lineberg that we would mention that our bankruptcy book is being updated. So if you do order or you have purchased the bankruptcy book from Lineberg, let me know and I'll be glad to send you the updated version. And we hope to have a CPA only version in the future with Ken's picture on it. So please send Ken an email. If you're friendly with Ken, please cut him off completely until he completes his edits on a new CPA bankruptcy book. I promised my friend Jerry Hesh that I would plug the Notre Dame Tax and Estate Planning Institute. I am really looking forward to participating in this institute. It's all virtual this year, so it's your chance to really get hold of some amazing original programming. Jerry assigns very good topics, and then he tells us how to do them and why to do them. So you see material at Notre Dame that just doesn't ever get seen anywhere else, with, of course, the best speakers, not including me. And in the estate tax area, Jerry and Marty Shinkman and I put together a webinar called the Biden Two-Step. It is 90 minutes on what to do for estate tax planning in case there's a Democratic sweep. We have found that clients really enjoy it. I'm not sure why, but take a look anytime if it's of interest. Ken, I've got your bio here. What are your words of wisdom for CPAs who really are not in this area yet, but have an interest? How can they find out whether this is a good area for them?
That's a great question, and it's a somewhat of a new skill set, but borrows from a significant amount of the skills that they've learned over the years. It requires a commitment to learn something new, something different, to be able to get into more of a legal arena, to work with attorneys and other professionals to bring a resolution to somebody who's got some really significant problems. So with that, I'll dive in a little bit, and hopefully we can get through this, what I turned out to be a little bit more meat than I thought we were going to do today, but we'll get through it. So welcome everyone. I appreciate it. As I kind of glance up at a TV that's in the room here with me, I'm seeing all the stuff from the hurricane. If anybody's got any family down there in Louisiana, Texas, I hope they're safe and got out of there in time before this thing hit. It looks pretty brutal. So all the best wishes there. So I appreciated last week everybody tuning in. We spent a lot of time talking about the basics of bankruptcy, the different chapters, how bankruptcy flows and the processes, and give you that high level view. So this week, what I wanted to cover was to get down into the weeds a little bit, talk about some of the specifics that you're going to need to be successful with the various services that you're going to provide. Certainly what we're going to talk about is not the limit of those services, but there's some of the more prevalent ones that you're going to find year in, year out. So we're going to cover today retention and fees. You can already see that up on the screen. Talk about solvency and how you prove that, preference actions, fraudulent conveyances, taxes, and valuations. So if that's not enough to keep you awake for the next 45 minutes, nothing is. So let's get into retention. The issue here, and I'm scrolling a little too quick. There we go. In order to actually do work in bankruptcy for a client, whether it's being referred to you or it's a client you already have that is filing, you need to be retained by the court. You can't just start providing services because, as the next slide will show, you're not going to get paid, and that's generally a bad thing. Your partners do not appreciate that. In order to do that, there's some, and throughout this today, I'll digress for a second, I identified this week a number of the different code sections in the bankruptcy code. A lot of what you're going to see up on the screen is truncated. By all means, go to the actual code section so you can get yourself fully educated in the various specifics. So 327 and 328 deal with the retention of professionals. When you're being retained, a lot of the court jurisdictions around the country have their own rules about the retention of professionals, as we'll see in a minute, the payment of professionals. Talk to counsel, they'll get you up to speed on that. There are certain rules, of course, that are nationwide and other rules that are just limited to your particular jurisdiction. We're all used to doing engagement letters as accountants. We do engagement letters for everything under the sun. You may or may not need an engagement letter to do these services. It's not required, but in order to get all of the information on the table, or if you're being retained for just a very narrow slice of the bankruptcy, for instance, we've been retained just to deal with sales tax issues. You may want to do an engagement letter. I'll also tell you up front that the judges usually are not appreciative of all of the disclaimatory language we have in our engagement letters and are going to typically strike a lot of it right out. So work the balancing act. Occasionally, and unfortunately, you may find yourself being a creditor in a bankruptcy and seeking to be retained in that same bankruptcy. I'm sorry that you're a creditor, and hopefully you're not a top 20 creditor, but that's not a deal breaker. What it's going to mean, though, is that you're probably going to have to waive off that claim in the bankruptcy in order to be retained. So just be aware that that's going to happen. And generally, it's one of your other partners that it's their client, and they're bringing you in as the bankruptcy expert, and you get to deliver that news, and it makes your partners also happy. To be retained, you're going to have to lay out all of your credentials. What your credentials are, why you're the right person for the job, the basis of the retention, why you're being brought into the case. You're going to need to disclose your fee structures for the firm as well as the primary service providers for the case. It's a great way to find out, exactly what the other professionals in the area are charging as well. You also need to be something called disinterested. In accounting parlance, independent. Essentially, it means you don't have a connection with the debtor, any of the other creditors, or any of the other parties that are involved in a case that might impair your ability to do your job in a disinterested manner. As I mentioned, you may get in some of these larger cases. There are hundreds, if not thousands, of creditors. You're likely to be providing services to some of them. It's okay as long as you're not providing services specific to the bankruptcy. You can do other things. But of course, you're going to get retained, and you do in fact get retained by the court. At that point, you can begin work, and then at some point, you actually want to get paid. That again, you got the code sections there. This is an area that's ripe for local rules and forms, so pay attention to that. The Office of the United States Trustee has some specific guidance. There's a hyperlink to that. You can certainly go pull that right down. Large Chapter 11s, typically some of the early orders that are going to be done by the court are going to be fee orders in terms of how you're going to get paid and when you can submit a fee application. You cannot get paid until a fee application has been submitted to the court and approved by the court. Your collections folks will not understand that, and your partners certainly are not going to understand it, because it's going to be a significant period of time between when the services are provided, the fee order is submitted, approved, and ultimately paid. It's the nature of the beast. It's what you're buying into here. That's the price of admission. Your fee application is going to be summarized by category, both by hours and dollars. Expenses need to be detailed. Of note, and I know we do it here in my firm, a lot of times expenses are allocated, or there's just a flat fee associated with particular types of services. You can't apply to have those expenses applied in a bankruptcy. They need to be actually incurred expenses. You're going to need to essentially provide your WIP runs. Name, date, title, type of service, rates, how much time was spent, and the associated fee, and a description of what was done person by person, entry by entry. You'll need to train your younger staff on descriptions to make sure that the court can equate the time that they're putting in and identifying with the work that was done. Every now and then, once your fee application is submitted to the court, one of the creditors or the Office of the United States trustee, or maybe even the debtor, are going to object. And they're going to complain about the amount of the fees you're being paid for the services that were provided. Sometimes you can work that out ahead of the game, and prior to an actual hearing, it can get resolved. You can adjust your fee application, and everybody gets on with life. Every now and then, though, you're actually going to need to show up in court, because most fee applications are heard on the papers. You don't actually show up in court. If it's objected to, you'll need to show up in court and defend your fees. Always a happy occurrence. Thankfully, I've not been on the receiving end of too many of those. And then finally, how do you actually get paid? Depending on the case, the trustee will pay it, the debtor will pay it, depends. You may only be paid a portion of your fee application, depending on the amount of dollars in the estate, with the balance paid later, hopefully. You do run a risk here of not getting paid at all. There are cases where you can get into and there's just not enough money. And for whatever reason, you're just not going to get a fee, or you're going to get a very nominal fee. It's the price of admission as well. Or you could conceivably take a significant haircut. The other nasty thing that can happen is if, again, in a case where there's not enough money, all similarly situated professionals are going to get paid pro rata. So you could take a significant haircut. Everybody will be sharing the pain. Again, not a happy occurrence. Your worst case scenario is you got overpaid and other professionals weren't paid at all or weren't paid enough, and you needed scourge fees. Another happy occurrence, which gets your partners thrilled with you. Trust me. Thankfully, I've not been on the receiving end of one of those. So let's get into some meat and potatoes here. Solvency. Seems kind of counterintuitive to even be talking about solvency, because we're talking about a bankrupt entity. Why do we even have to bother? Well, day one of accounting, when you first entered into that accounting 101 class, that some professor somewhere put up a formula up on the board and said assets equals liabilities plus equity. And that is basically the definition of insolvency. If the debts are greater than the assets, equity is therefore negative, working the algebra there, and you have an insolvent entity. Seems like a simple definition, not so simple to demonstrate. Where solvency comes into play is when we start getting into avoidance actions, and fraudulent transfers is probably the spot where you're going to spend dealing with insolvency. And given the amount of material here, I'm not going to read all this to you. There's a lot on this slide, but just know that a fraudulent transfer is a movement of property by the debtor prior to the filing of the bankruptcy. In this case, 2 years if it's an insider, that caused the creditors not to have access to that property for the satisfaction of their claim. That's kind of it in a nutshell. That transfer was done for less than reasonably equivalent value. So they didn't get a reasonable exchange. They can always move property and get full value for it. Pro tip, reasonably equivalent value, while it's in the code, is not defined. So you need to figure out what reasonably equivalent value means in your particular case. If there was actual intent to move that property, then we've got an actual fraud. And that's kind of a different ballgame. We're going to talk about that a little bit later on. Where the insolvency issue comes into play is in a constructive fraud, where that property was moved, and you can see the bullets down here, at a time when they were insolvent, or at a time when they had unreasonably small capital, or when they had debts that were beyond their ability to incur. And again, I've truncated all that. There's more to it. We're going to talk about it in a second here. Your job is going to be to prove that they met the criteria for insolvency at the point in time when that transfer occurred. It gets more interesting. So now you've got to prove it. Now you're proving this well after the fact. The property was moved, the bankruptcy's been filed, you might be a year down the road, and now you've got to go back in time and try and demonstrate this. And in the case of insiders, it's 2 years. And if they use a state statute of frauds, it can be 6 years. So we can be talking about a very significant period of time here that you've got to dig into. the first and most important thing you need to do if you're going to try and prove solvency is get your arms around the debtor, its historical performance, how the third parties are reacting to it, what the industry circumstances were during the period of time. I had one with a real estate entity. The owner happened to be a CPA as well, and the transfers were done in 2000 and 2008 when the real estate industry was in a funk. And it really made our job a little bit easier because we couldn't cross all the T's and dot all the I's and some other stuff. Solvency always comes down to a battle of the experts. You're going to need to talk to counsel about certain decisions that have come down in your district regarding the 3 tests for solvency that we're going to get into in a minute to make sure you can align your fact pattern with the cases that have come down. There is almost always a lack of information. Again, we're well after the fact. You may have some financial statements, but not all. You may have some tax returns, but not all, or they may have been done by that local tax preparer and their numbers on a piece of paper. You're going to have to rely on a lot of non-financial data, loan agreements, merger and acquisition activity, depositions. You're going to need to use them to tie it all together. The petition can lead you to different areas of potential discovery that you're going to want to dig into. And then there may, if you're lucky, have some management projections that may help you understand what management was thinking at that point in time. We'll talk about that a little bit later on. As I mentioned, there are 3 tests for solvency or insolvency, depending on which side you happen to be trying to prove. You only need to prove 1. And then your debtor will be considered insolvent. It is always tested on the date the transfer happens. The case I mentioned before, there were a whole series of transfers, and we ended up just doing it on a quarterly basis because to do otherwise would have been just insane. Importantly, and as is with any valuation engagement, it's known and knowable. Hindsight does not come into play here. So you need to be aware of what management knew or should have known at that point in time. And you can't jump to, well, they filed for bankruptcy ultimately, so it was a bad thing. Let's talk about the 3 tests real quick. First one, and probably the one with the most litigation around it, is the balance sheet test. The balance sheet test is, in accounting parlance, we're going to look at the fair value of the assets, we're going to look at the fair value of the liabilities, we're going to compare them, and we're going to see what the result is, solvent or insolvent. We all know as financial professionals that when you just look at a balance sheet, that the assets are recorded at historical cost. They're not at fair value. That needs to be adjusted. We also know that certain assets don't even appear on the balance sheet. All of the intangibles, patents, trademarks, on, don't even appear. That stuff needs to get value. So we're looking at a classic valuation engagement here in order to derive those values. Liabilities, similarly, were typically recorded at face. That's generally right on the face of the balance sheet, but what's not on the balance sheet are contingent liabilities that may not have met the criteria to be recorded. Now you got to be careful here because of hindsight and understand the issues and stress test things to see how it all floats out. Kind of a question for the crowd is, well, what do you do with related party loans? And that's going to be a challenge that you're going to need to confront if you've got loans out to either related entities or related individuals. Are they really loans? Are they really equity? Are they something else? What are you dealing with? How does that play into this valuation exercise? The second test is an inability to meet obligations as they come due, better known as the cash flow test. In this particular one, you're looking to see if the movement of the property or the obligations that they're incurring left them at a point where they're not going to be able to meet their obligations on a go-forward basis. It's not just simply a matter of looking to see if accounts payable is getting stretched. They're in distress, and they filed ultimately for bankruptcy. Accounts payable got stretched. Or if they're bouncing checks. That's kind of icing on the cake stuff. What you're really looking at here is their long-term debt and their other obligations, and you're going to line that up basically in a spreadsheet, lining up when the payments are due, and then you're going to need to develop a cash flow forecast. But hopefully you've got some projections for management to lie up against that to see if the cash flow is going to be able to meet the obligations to get here. Again, some questions that you may run into. What if management is able to come to the table with some cash and make sure that even though there may be a cash flow shortfall from operations, that they're not going to default on obligations? What if the debt can be refinanced? What if there's a balloon out 3 years and they can refinance that obligation? And that's the intent of the parties all along. Should you consider that? And of course, you need to stress test all this stuff, particularly if you're going to be using management's projections to get to the cash flow. And finally, insufficient capital. This isn't so much a test of insolvency as it is a precursor to insolvency. And I'm borrowing here from credit where credit is due. Jones Day wrote an article in 2014 that highlighted this, which I thought was very well done. And I've used the concepts and the things that they've laid out here in some of my analysis over the years. And really, I kind of point to the Moody's decision that came out there, and I will read from a slide. I apologize. Unreasonably small capital refers to the inability to generate sufficient profits to sustain operations, because an inability to generate enough cash flow to sustain operations must precede an inability to pay obligations as they come due. Unreasonably small capital would seem to encompass financial difficulties short of equitable insolvency. So if you think of insufficient capital as insufficient cash flow, and you look at it through that lens, you're probably going to get to the right answer here. There are obviously a number of other things you need to consider as you go, and when you're considering it, it's not just meeting obligations as they come due, but it's also is operations going to provide enough cash flow to take care of unforeseen issues that may pop up. Certainly not a pandemic, but normal cyclical cash flow needs of the business. Are operations going to be able to take care of it, and do they have enough capital to ride through those storms? So some more questions for the panel as you're thinking about insufficient capital. What about the ability to refinance? What terms are being offered by lenders? Are they typical terms that you would expect, or are we leaning a little bit more toward hard money now? And the interest rates are creeping up. The covenants are being cranked down and the terms are being shortened. It's going to be an indicate that a third party thinks that there's some stress here. How does all of this impact operations and the cash flow forecast that management is throwing at you? Can you convert short-term debt to long-term debt? If I've got a vendor I owe a ton of money to, and they're allowing me to term it out, or I can take my credit line and term it out over a period of years, and the lender is happily going to let me do that, what does that mean? Again, what if management's got deep pockets and can support the operations? What does that mean? Are there assets that have significant equity? I'll use real estate as an example. Maybe there's 50% equity sitting in the real estate over and above the mortgage. Is there ability to unlock that and get the cash? I don't know. And how are the other lenders reacting? So there's a lot of things that you need to consider and poke at to get to these determinations. Preference actions. Preference actions are one of the two types of avoidance actions that you will certainly confront as a financial advisor. We talked about fraudulent conveyances briefly, and we'll talk more about it in a second. What the heck is a preference action? We talked a little bit about it last week. So again, let me synthesize the slide for you here. At the end of the day, a preference action is a payment made by a debtor within 90 days of filing for protection of bankruptcy, or a year if they're an insider, that allowed that creditor to get standing that other creditors did not have the same standing. So they got more than if everything was being whacked up pro rata, they would have otherwise been able to do. The recent Small Business and Reorganization Act put some new terminology in the definition of a preference, and it's highlighted up there at the top, based on reasonable due diligence in the circumstances, taking into account a party's known or reasonably knowable defenses. We'll talk about defenses in a second. So the dirty little secret of preferences is that a trustee would get into a case, or a creditors committee at the end of a Chapter 11 would start going after preferences. They would look at all of the dollars paid within the 90 days prior to filing, and they would send love letters out to all of those vendors saying, give me my money back. Your clients really love when they get one of these letters, by the way. It's a very happy phone call. That action that was taken allowed trustees and creditors committees and liquidating trustees to fund bankruptcies. It generated cash, and it was a great big let's make a deal. Sorry for airing some dirty laundry here, but that's essentially what it really was, and to a certain extent still is. The new wording was put in place to try and rein that back in a little bit, meaning if you're going to get into this and you're going to do the preference analysis, and as a financial advisor, you're going to do the preference analysis, you've got to take the added step of understanding whether or not the potential party that will be the target of that preference analysis has a defense, and you should not be bringing that action to start with. That, I will tell you, particularly in a Chapter 7, is going to be a significant hurdle to get across, because the records are typically awful, to use a technical term. And you're going to need to use best efforts to try and figure it out. There are a number of defenses that are available. The easy one is the so-called de minimis defense, which means if that creditor received less than $6,800 in that 90-day window, they're done. They're off the table. We don't have to worry about them. The second level of defense, or not second level, but one of the other defenses, is something called contemporaneous exchange for new value. And here what we're looking at is the relationship of the parties, the creditor and debtor situation, to determine if in fact the relationship is a contemporaneous relationship. I'm going to deliver you goods, you're going to give me a check. COD, everybody's heard of it. Some industries, letters of credit are prevalent, particularly in the shipping industries. If in fact the relationship is contemporaneous, then that gets moved off the table. We can't chase those. But again, it needs to be the intent of the parties. That's important. It needs to be in fact contemporaneous. It actually has to happen in order for this to be a valid defense. The third one, and this is where one of the ones where all the litigation sits, is payment in the ordinary course of business affairs between the debtor and the transferee. So again, we're looking at the relationship between the parties, and we need to figure out what the normal relationship is. There's no definitions here. So you're going to need to look at what's been flagged in your district. You're going to need to take a look at the history of the relationship between the two parties. When were payments made? When were deliveries made? When were the checks cut? And you're going to need to lay that out over a significant period of time. It's going to be at least a year prior to the filing of the bankruptcy, possibly longer if you can do it. The problem is inevitably going to be, as they get ever closer and facing financial distress, the payments are going to start getting stretched unless that creditor's got some significant sway over the debtor. You're going to need to look at what's normal in amount. Are they full paying invoices? What's the normal manner of payment? Is it by check? Is it by wire? What's the normal timing? What's the timing between the time the goods are delivered and that check clears the bank? Because when the check clears the bank, that's relevant. Have there been any collection efforts or other? I've had a number of times where I've gone into emails of debtors and found all kinds of emails from vendors banging the pots and drums about getting paid, and they're not going to do this if they don't get paid. They're not going to do that if they get paid. Well, they just blew up this defense. And not taking advantage. You've really got, it's very facts and circumstances sensitive, and you've really got to dig in here and understand what's going on. The second layer to this particular onion is under ordinary business terms. And this is kind of it's not a two-part test, it's an either or. So you can get a defense by ordinary business terms. And again, this is this is going to be a battle of the experts. You're going to need an expert who can talk to what the specific terms are in the industry that they operate in, and then overlay the actual activities that occurred. And the final defense is new value. And this is a math exercise. So if a payment was made in 90 days, after that payment was made and cleared, were new goods or services provided? How do those two amounts line up? And we keep doing this leapfrog thing all the way through the 90-day period. Fraudulent transfers, we already mentioned a little bit, so I'll just kind of round this one out. If it's an actual fraud, we default back to our, the typical fraud analysis, and we're going to look at the badges of fraud. It's the actual intent, hinder, or delay. Again, look at the cases in your particular jurisdiction. I listed some of the more typical badges of fraud here. They're certainly not all inclusive by any stretch. Constructive fraud we talked about. Again, identify with counsel whether or not you're going to use the state statute of frauds or you're just going to use the bankruptcy statute of 2 years. Some of the issues I've run into over the years is excess compensation, transfers to related parties or entities not at arm's length. Smaller entities, you have the infamous officer's loan receivable, which is just a way to subvert compensation. The one I've seen a bunch of recently is new entity, old operation, where suddenly a new entity springs to life and magically it has the old entity's customers, equipment, location, telephone number, operations, vendors, the whole employees. There's really no differentiation between the old and the new, other than the old has a whole lot of debt that they didn't want to pay, and that's the entity they filed bankruptcy in, thinking nobody would figure that out. That doesn't even take an intern to figure out. No-show jobs for families is a big one, particularly if it's second generation. Maybe mom and dad are down in Florida. No offense, Alan. And they're still on the payroll, but the second generation is actually running the business. And then lots of personal expenses is always big. So let's dig into taxes, because I know this was a bit of a question last week. So we'll spend a few minutes here on some of the tax stuff. Bankruptcy has a number of priorities for payment of unsecured creditors. There are 10 of them that are enumerated in the code under 507. We're not going to get into the ones other than the slide just kind of flags that taxes, and that's an expansive term, is an 8th priority claim. So all these other claims, including yourself, you're in the administrative expense category, will get a preference over taxes, assuming that it doesn't meet certain criteria. So the question that always comes up, in the slide deck, is 507A8, which is the most of the what taxes will be considered in that 8th priority claim. So taxes measured by income and gross receipts, and the criteria that they will get preference, property taxes, excise taxes, employment taxes, customs duties. The penalties associated with those taxes will generally follow right along. Some of the key wording here, though, is time periods that are suspended, the tolling of the statute of limitations, and I'll talk about that in a second. So one of the questions that always comes up by people that are chatting with you about filing for bankruptcy is, I've got a lot of tax debt. Can I get it discharged in bankruptcy? And the answer is maybe, sorta. You can hardly give them any kind of real certainty around that, because it is very fact sensitive. If the IRS or the state governments have already got a judgment, they're a secured creditor, that's not going to get discharged, or at least they're not going to get out of the secured claim. The taxes that can be discharged in bankruptcy need to be, and you can look at the test here, taxes that were due 3 years before the filing, including extension. So at the moment, we're kind of talking about tax returns that were filed 2015 and prior, right? Because with extensions, they were due in October 2016, and 16 returns, we're not quite in October yet, so the 16 returns are still out there. The return was filed at least 2 years before the filing. So if you've got a delinquent filer and is playing catch up, prior to them filing, those returns need to be filed at least 2 years before the filing for the petition. The tax needs to be assessed at least 240 days before the filing. The only way you're going to figure that out is to get transcripts from the IRS. And of course, no willful tax fraud or willful evasion. That almost should be without saying. So those are the benchmarks you need to hit. And typically you're going to get transcripts from the IRS and kind of lay this all out. You're going to interview the debtor and find out exactly what's going on with their tax compliance. The trip where you trip up here is where the statute's been extended. The 800-pound gorilla is the offer and compromise. If the file of a prior bankruptcy also comes into play, collection due process hearing, will all extend the statute of limitations. And 3 years from now, when we're talking about this topic, remember that 2019, all the due dates were extended. So we need to be conscious of that in 2023, 24, something along those lines. So non-dischargeable all the time. Trust fund taxes, we talked about that last week, and fraud penalties are not dischargeable. So let's talk about some specific tax issues that you're going to confront as a financial advisor in this world. Unfiled returns. Those are the debtor's problem, not yours. In a Chapter 7 for individuals, the filing status is always married filing separate, even if it is a joint bankruptcy estate. A separate estate is filed, is formed on the date of the filing for protection. You're going to file Form 1041. There's going to be separate federal ID numbers for both spouses if it's a joint filing. And the final thing is that the individuals have the opportunity to file a short period election and file a short year return on the day before the filing for protection, and then for the balance of the year. Entities, there's no changes. Everything continues to move forward. If you've got missed periods, you've got missed periods. It's on the debtor. And then former ownership. Pass-through issues, again, if it's a missed period, they may be missing out on deductions and losses that they otherwise could have taken advantage of. That's on them. There is, particularly for pass-throughs, if there is no change in ownership. So you're still issuing K-1s to those same people. And if the bankruptcy trustee in a 7 sells a large piece of property and there's a gain and it passes through, sorry, Mr. or Mrs. Owner, you're getting tagged with a very big tax liability and you're not getting a dime to pay that tax liability. Have fun with the IRS. You cannot alter your LLC taxation elections or your S election prior to filing for bankruptcy. That would be transfer of property to the estate, fraudulent transfer. Okay. You will become intimately familiar with Code Section 108, cancellation of debt, and the bankruptcy exception. My only heads up there is just watch for state issues as well, and the waiver of the tax attributes. 108 is a whole separate session here. If, particularly on the individual cases, if you're selling property with recourse debt, namely the home, you may have a gain in addition to cancellation of debt. So just be conscious of that. CARES Act gave us carrybacks that we might be able to fund our state with. That's good news. Let's take a look at those. Your trustee that you're representing is only responsible for the period of time that they are a trustee, and they are not about to sign a tax return for the period of time that they are not a trustee. So again, those gap period returns, it's on the debtor to file them if they want to. Some things you should absolutely be aware of is something called a 505B election. If you are working on behalf of a trustee and filing a tax return for them and you don't attach a 505B election, call your malpractice carrier. The 505B election shortens the statute of limitations for an audit from 3 years to 2 months. So you can see the power of a 505B election. And it puts the IRS and the states on notice that they've got a limited period of time to question that return and trigger an audit. We as and I know a number of my other practitioners I've talked to over the years, on any return we file in the bankruptcy action, we put a disclaimer with that return, basically saying, we did what we could with what we had, good luck with that. And you know, we identify that we're not filing under penalties of perjury, and that neither is the trustee if their name is on it, particularly for an entity level return. because a lot of times, particularly that first year, you're marrying the debtor's information with the trustee's information to file that first tax return. So the trustee is taking a little bit of a leap of faith that the information is accurate. Some resources for you. IRS publication 908, that's what I was referring to before with the individual returns. There's stuff in there on entities as well. Take a look. The IRS does a very nice job of laying that all that out for you. Internal Revenue Code section 1398 is where you'll find all of the IRS issues that you need to deal with. And two publications I found very helpful over the course of my career that really lay out tax issues quite nicely. Collier and Tax Aspects on Bankruptcy Law Practice is another one. Very well done publications. Just an unsolicited testimonial to give everybody a leg out. And final topic of the day here, and sorry to rush through some of this stuff, is valuation. We're not going to talk about valuation process because there is nothing different here in bankruptcy versus what you're going to do in just an ordinary valuation engagement. It's all the same. There's some nuance you need to be aware of and some heads up to be paying attention to as you're going through the process. So to kind of start out, and as a professional, you've got standards you need to be dealing with. The CPA's got SSVS1. If you're a valuation professional, you know what that is in your CPA. The AIRA, the Association of Insolvency and Reorganization Advisors, also has a set of standards for valuation of distressed businesses. They also have a credential, the Certificate in Distressed Business Valuation, that you can obtain. If you're going to practice in this area, not a bad idea. You should be paying attention, obviously, to in any of the trade groups that you're a part of and what their standards may be. So where does valuation fit into bankruptcy? I've already mentioned it probably 50 times over the last two sessions, but I'll run through a couple of these that I haven't covered previously. Adequate protection. Where that comes into play is early on in the case, secured creditors are going to typically want to get their collateral back because they're secured and they can look to their collateral. Or their collateral, for instance, a bank will have just a broad blanket lien on everything. They need to receive something called adequate protection. And depending on how over or under secured they are, the debtor may need to make payments to them to deal with the diminution in their collateral. As a valuation professional, you're going to need to take a look at the value of the collateral and the value of the underlying debt that's sitting there to determine how those two items line up and whether or not adequate protection is absolutely necessary or not. Claims determination, we've already talked about that a whole bunch, both in the preference claims, fraudulent conveyance claims, as well as just proof of claims that are filed by creditors as they submit them. Avoidance actions we talked about today. The plan of reorganization, you're going to spend a lot of time doing some evaluation work there. The plan itself needs to have projections built in so that you have identifying how the debtor is going to move forward. Something called feasibility. Is the plan actually feasible, or are they liable to file again, or worse, need to liquidate? If there's a cram down, best interest of creditors test, liquidation analysis, fresh start accounting for Chapter 11s that are emerging will need to realign their finances. Tends to be a little bit more of a Big Four issue because of the change in control that comes along with it, and certainly solvency we've talked about. The last couple minutes here. So you may or may not have some projections from management that you're going to use in your valuation analysis, and which is typical, right? You're getting management's projections of what's going forward along with some historical financial data to try and build your valuation analysis. Well, let's keep in mind that management are the guys who got us here. So you need to dig into them and make sure that there's some validity to what they're laying out there, right? Have they been able to predict this stuff through history? Why were the projections prepared? Were they just trying to paper something over? Were they ever vetted by third parties? And can you get access to management to kind of interview them and understand what's going on here? And absolutely, absolutely get some supporting documentation behind these things, because I can promise you in cross-examination on the stand, when you're presenting your expert report, you can expect that your reliance on management's projections is going to get just a little bit of attention. And finally, some of the unique considerations for evaluation of a distressed entity. Again, known and knowable. Think about your company risk premium. You've got a distressed entity here. Comparable companies are going to be near impossible to identify. You know, what's been the history? What's the current state of the debtor? How are they going to get from where they are to where they think they're going to be under the plan? You know, what's the state is the industry in? They may have sold off a whole lot of assets through the course of the bankruptcy. Do they still have the same capacity to reach the projections that they think they can reach? Is the equipment new, old? Can they do it? Is there a whole bunch of deferred capital expenditures as they got closer and closer to financial distress that they put off, that now they need to reinvest into property and equipment in order to be able to produce what they think they can do in their valuations? You know, how are lenders looking at them? Is equity going to put in some new capital? And then let's not forget about tax attributes. We've got net operating losses now that we need to be thinking about and how those impact our valuation. So there's a whole slew of tax changes that come into play. So that was a bit of a whirlwind tour of financial advisor services in bankruptcy, and I hit 12:45 on the button. So Alan, I'll turn it back to you if there's any questions out there or thoughts you may have any of this.
That was really, really good, Ken. What percentage of your time is spent mostly on one or two of these subjects you just covered? And how does that work out economically?
So most of my time, it really, I spend a lot of time working with bankruptcy trustees. So as a result, the preference actions get a lot of attention. Tax issues get a lot of attention. Fraudulent conveyances, the constructive stuff certainly does. The need to do a full-blown expert report is few and far between. That's a little bit more of a unique animal. Valuation, I mean, that's all over the place. So you're always doing something. Sometimes not the formality of a full-blown valuation report, but you're looking at information to provide back to the various players, depending on which side you're sitting on, and to validate, if you're on a creditors committee, what the debtor is laying out there, so you get to be on the other side and kind of poke holes in things, which is somewhat easier.
And then, you know, I know that the clients typically are just looking to the lawyer to save the day and be the white knight and give them all the advice. And I know some of us lawyers don't listen so well. So what are the primary blind spots or areas of concern that a typical Chapter 11 lawyer may not cover as well unless they have somebody like you riding shotgun?
It's an interesting question because it's really two-dimensional. It's my relationship with counsel and my relationship with the debtor. My relationship with counsel really means confronting the case and making sure that they're seeing what I'm seeing, because you know, with all due respect, a lot of the attorneys I'm working with are not as up to speed on how to read a financial statement, how to read a tax return, and what I'm able to interpret from that they may not be able to glean. Helping them with depositions, our 2004 exams, in terms of developing those kinds of questions. My relationship with the debtor is usually very different, and it almost takes on almost like a neutral role between the debtor, their counsel, and myself, where I'm helping them understand and interpret what the attorney is telling them and what this means to them in the real world and what the potential ramifications are to them. It's a little bit of playing attorney I shouldn't do sometimes, but they're scared and they're worried. This is their livelihood and this is their baby, and they're trying to wrap their head around it, and it's really difficult because they're completely fish out of water.
I think a lot of times the CPA has more patience, more attention to detail, and maybe a little bit more gentle than the type of lawyer.
I don't know about the patience part, but yeah, certainly attention to detail.
Beautiful. So Ken, if we brought you back for another 45 minutes, what would you cover that you think would be of use to CPAs?
I think because tax is so prevalent so much everywhere that, a deeper dive into specifically into tax issues would probably be the most beneficial use of those. Certainly, I'd be interested to hear what the crowd has to say here. Perhaps getting into some of the specifics of the defenses for preference actions and how that actually plays out, because you could have those issues if you're just representing a creditor. And not necessarily just you're not in the bankruptcy, you're just helping out one of your clients who's gotten one of those love letters.
Great. So you guys have our email addresses. You've got Ken's and you've got mine there. If you have any questions, comments, or suggestions, let us know. I do expect that we'll schedule another one of these on a Thursday for 45 minutes on the taxes at least, because that's something I definitely want to hear about. And maybe Ken can bring a couple of hypotheticals to show us why it's important to do some tax planning well before filing bankruptcy if you think that that's part of the game. As I always say, if you have any other questions, please send me the easy ones and Ken the difficult ones. Ken and I are going to be presenting together for some AICPA type of events, and we're going to be hopefully writing together if he can come in and save my bankruptcy book.
Absolutely.
If anyone on this call would like to participate in any sort of situation or writing or brainstorming, etc., just let us know. I hope that everybody has a great day. As Ken said, I hope our hearts and our hopes go out to anyone in Louisiana being impacted by this storm, directly or indirectly. Stay home, stay safe, and may the rest of your day be billable.
Thanks, everybody.
Thank you.